Show. Personal Finance.
Warren Ingram from Galileo Capital in studio with us this evening. Warren, the things that we know, the things we can calculate, the things we can guess with a fair degree of accuracy. And then there's the other 95% of things that are going to affect the value of our money this year that are nowhere near on our radar right now.
100%. The known unknowns.
You're going to sound like Donald Rumsfeld in a moment. There are things we know, there are things we don't know, there are things we don't know we don't know, there are things we know we don't know, and those that we know that we do know.
Which sounds
that sort of stuff.
Like the whole investment world in one nutshell.
Yeah.
And I think we're there. I mean, so just to give you an idea of, sitting in this studio 12 months ago, I think it would have been really difficult to say, okay, we know the rand's going to be, below 13.50 to the dollar in 12 months' time. We know that Brazil's stock market's going to give us more than 80%. Russia's going to give us more than 80%. Oil's going to go up. Now let's invest.
But also we couldn't this time last year have said that Brexit would happen, that the US election would happen, that the ANC would lose 3 metros in the local government elections. And those are all things which are net positive or net negative for markets generally, and also for our psychological state, depending on where we sit in the South African political space. And
it's amazing. 12 months ago, we were deeply rattled as investors. We were just in such a funk. The world was a lousy place to be, and things weren't going to go well. And it was interesting. By the end of the year, the JSE hadn't made much money. I think around 2.6%. Not great, but if you'd asked me in January, I probably would have, if I had to have bet, which I don't like to do, but if I had to, I would have bet that the JSE would have been down. And I certainly wouldn't have bet that in dollar terms the JSE would have done as well as it did relative to the international markets. And so now we look at this year, and I can't tell you how many times I'm getting questions like, how do we invest for Trump? We can see this Trump rally happening in America, and the stock markets might be good, and if you own cement companies in America, that's going to be a great investment because he's going to build this enormous wall. And the difficulty I have is we actually none of us really have a clue. We can see his first few actions in power. It looks quite protectionist, which as history will tell us, protectionism is bad for global trade. Everyone gets poorer as a result. But that doesn't help us really over 1 year, because that's a multi-year, if not multi-decade strategy. And also, we don't know what his whole strategy will be around building proper productive infrastructure in America as opposed to a wall. Does he build roads and airports and those kinds of things? And is that good for America, which might be good for American companies? And is that going to be offset by his protectionist behavior? We just don't know. So it's amazing to me that the markets, when he was elected, immediately crashed and then immediately recovered and have gone on this rally. To me, trying to be sort of irrational about this, it seems to me completely irrational behavior. Surely you wait, you see what the proper policies are, and then you start to make an investment decision.
Markets, however, like to anticipate. And if they get it right, then you see valuations maintained. If they get it wrong, you see collapses in the value of shares. That's what breeds booms and busts. And the people who can best read the temperature, or who are most lucky, maybe, are the ones who make the money. If you wait for certainty, Warren, you're never going to do anything.
Sure, and I think it is a great point. What history tells us, though, is that investors, both private and professional, and institutions, etc., are not very good at this anticipating thing. So typically they cost themselves about 3.5% per year over long periods of time. Now, to give you a context, 3.5% a year is the difference between retiring comfortably and retiring very uncomfortably. Possibly not being able to retire. Mm-hmm. So I would say that, yes, markets like to look forward. What we also know is over shorter periods of time, markets can be deeply irrational. And so, the clever listeners we have on this show, should be looking at this and saying, I'm not going to buy into the hype of a Trump rally because, no one actually knows. And whatever's going on now is based on pure supposition. You probably have better odds of making money if you went and, put it on red or black in the casino. Rather wait, and if you need to invest money, take your time, do it over longish periods of time, feed your money in. And if you don't know what direction America is going to go, then just go the index weight. In other words, if America makes up half of the world stock market, allocate half of your offshore capital to the American market and see how things unfold. Once you get a better indication of real policies and actually concrete actions that are being taken, then you can start to tilt your investments in one direction or another. But I would hate to take a huge punt, and that's really what it will be, a huge punt in one direction or another, because firstly, you've got to be accurate on the direction that Trump's going to take, or whatever the event is. Secondly, you've got to figure out how to make money out of that. But thirdly, you've got to anticipate how other people are anticipating. And that's a mug's game.
It's idiocy. It really would be. Oh, okay, so do we just carry on as normal? You keep your 500 Rand direct debit and you just keep popping it into your index fund, or you keep your 1,000 Rand going into your unit trust, or you just keep your pension ticking over and you just hope that everything works out fine?
I think that's really a good strategy.
It's the blind leading the blind.
Well, what's amazing is that what you end up doing is you end up acting rationally when everyone else is acting irrationally. And it's very hard for people to do, and so I'm not saying that this is an easy thing to do. And then I think secondly, just with in a South African context, looking at the rand now, I mean it's clearly on a strengthening trend. So
this time last year, you were saying if the rand gets to 13 Rand 50, that'll be the time to take money offshore. Have you moved your goalpost?
Not at all. Not at all. So
you're still sitting there?
So definitely, and certainly that's the advice I'm pushing pushing people to consider. What I would say is, if you let's say you've got 100,000 Rand to go, don't necessarily send the whole 100,000 Rand off at 13.50. You can probably do it in one or two batches. In other words, send 50,000 out now, wait 3 to 6 months, and then send the balance, or send a third out now, a third in 3 months, and a third 3 months later. Because if this trend continues, you might, and I'm certainly not predicting or forecasting, but you might see the rand below 13, and maybe even 12.50, which would be my sort of dream scenario. But sometimes dreams come true, and then you take advantage. But if if the rand goes the other way, we get another political shock. At least you've locked in a decent rate now.
Okay, got you. A couple of questions. I've been stalking you on Twitter, and I've seen questions that people are asking you. This was an interesting one because a lot of people think about this stuff. If you had to emigrate from South Africa, which country would be the best to go to investment-wise? Where would be the best place to take all your money?
I wouldn't select a particular country. I think if you don't know, in other words, if what you know is that you don't want to be here, but you don't know where you're going to, then I would certainly take a very global approach. I would really replicate what the world stock markets look like. So, there's things like the MSCI World Index, and I would look at something like that to allocate my investments to, and I would be careful of taking a very big currency bet on one direction or another. I would spread my currency view as well on a global basis. However, if you know as a certainty that you're going to, it would be wrong to say the dumb move here, Bruce, but if you knew you were going to Australia, for example, then you would definitely want to allocate a large portion of your capital to Australian dollars, because that's where your expenses are going to be. So I would spread it or go to the country that you are moving to.
Could you spread yourself too thin? So if you go for the MSCI World Index, you get the performance of the world's best stock markets, which is fine, but you're not getting any particularly big exposure to America or to Europe or to Australia, depending on where you decide to go. Is the MSCI World Index not just too diversified?
I think you end up getting about 50% exposure to America.
Okay, so you get the balance.
It's a bit like investing in the JSE. You get this massive exposure to Naspers, but you do get a lot of other stuff as well. So I think it's the same with America. You do get exposure to Asia, to the UK, to Europe, and none of us really know how those markets are going to unfold this year. So rather track the index. History tells us the index is not a bad place to go. It does make good money over long periods of time.
Okay. Warren Ingram from Galileo Capital. Thanks for coming in, Warren.